Imagine opening your Medicare bill and discovering you owe hundreds of dollars more every single month, not because you did anything wrong, because of one number on your tax return from 2 years ago. That's exactly what happens to thousands of retirees every year. They work their whole lives, save diligently, do everything right, and then Medicare sends them a surcharge bill that nobody warned them about. Here's the good news. This is one of the most preventable financial surprises in retirement, if you know what to manage and when to manage it. I'm going to show you how strategic withdrawals can help you control that number, protect your Medicare premiums, and keep thousands of dollars where they belong, in your retirement account, not in a government surcharge. Welcome to Retirement Security Simplified. I'm Shonda Prescott, and let's get into it. Let's start with the term you need to know, IRMAA. IRMAA stands for Income Related Monthly Adjustment Amount. That's a fancy government phrase for a Medicare surcharge. Extra money added on top of your standard Medicare Part B and Part D premiums because your income exceeded a certain threshold. Now, here's what makes IRMAA so sneaky. It's not based on what you're earning right now. It's based on your tax return from 2 years ago. So the financial decisions you made in 2024 are going to affect what you pay for Medicare in 2026. That 2-year look back catches a lot of retirees completely off guard. And it doesn't ease you into the surcharge gradually. IRMAA works like a cliff. $1, literally $1 over a threshold can bump you into the next surcharge tier and cost you hundreds of dollars more per year. Let me give you a quick example. Say a retired couple has a normal income year, but they decide to do a large Roth conversion in December to get ahead of taxes. That conversion spikes their income just enough to push them over an IRMAA threshold. 2 years later, both spouses see their Medicare premiums jump, and they have no idea why. This is called the IRMAA trap, and is completely avoidable with the right planning. So what's the number Medicare actually looks at? It's called your Modified AGI, or Modified Adjusted Gross Income. Think of it as the IRS's version of your total income picture. It includes most of the income sources that flow through your tax return, and Medicare uses it as the measuring stick for IRMAA. Here's what gets counted in your Modified Adjusted Gross Income for IRMAA purposes. Traditional IRA and 401k withdrawals, required minimum distributions, pension income, taxable Social Security benefits. Yes, up to 85% of your benefit can be counted. Capital gains from investments, taxable interest and dividends, and Roth conversions. Even though you already paid tax on the original contributions, the converted amount counts as income in the year you convert. Now here's the good news, and this is important. Not everything counts. Qualified Roth IRA distributions do not count towards Modified AGI. That's one of the most powerful tools available for retirees for IRMAA management. Health savings account distributions used for qualified medical expenses do not count. Life insurance proceeds don't count. And here's one most people miss. If you have a fixed indexed annuity or any annuity in a non-qualified account, meaning it's funded with after-tax dollars, the portion of your withdrawal that represents your original principal, your cost basis, is a return of premium. And that portion is not included in your taxable income, therefore not in your Modified AGI. Understanding what's in and what's out is the foundation of everything we're going to talk about next. Now let's look at the actual numbers. because seeing the dollar amounts is what makes this real. For 2025, the standard Medicare Part B premium was around $185 per month. That's what most people pay if their income falls below the first IRMAA threshold. But once your income crosses that threshold, the surcharges kick in. Depending on how high your modified AGI climbs, your Part B premium can jump to $259, $370, $480, or even $628 per month per person. That last part is critical. Medicare is individual coverage, so if you're married, both you and your spouse are subject to IRMAA independently. A couple in one of the higher IRMAA tiers could easily be paying $880 extra per month combined on top of their standard premiums. That's over $10,000 per year in additional Medicare costs for income they may have had in a single spike year. And Part D, your prescription drug coverage, has its own IRMAA surcharge layered on top of that. This is why modified AGI management matters so much. We're not talking about small adjustments here. We're talking about decisions that can cost or save you thousands of dollars every single year of your retirement. Now, let's talk about what you can actually do about it. Here are 5 strategies that can help you manage your modified adjusted gross income and minimize those IRMAA surcharges. Strategy number 1. Know your threshold and set a modified AGI target. This sounds simple, but most retirees have never done it. You need to know exactly which IRMAA bracket you're in or approaching and set a modified AGI target for the year. Think of it like a speed limit. If you know the limit is 55, you drive at 54. In this case, if the next IRMAA tier kicks in at $206,000 for a married couple, you manage your withdrawals and income to land comfortably below that number, not just below your tax bracket threshold. IRMAA planning and tax planning are related, but they're not the same thing. You can have a low tax bill and still trigger an IRMAA surcharge. You have to plan for both. Strategy number 2. Sequence your withdrawals intentionally. The order in which you pull money from your accounts matters enormously. If you have a taxable brokerage account, a traditional IRA or 401k, and a Roth IRA, those 3 buckets have very different modified AGI implications. Withdrawals from a traditional IRA count fully towards modified AGI. Qualified Roth distributions don't count at all. Withdrawals from a taxable account may only trigger capital gains, which can be managed. By being intentional about which bucket you draw from and in what amount, in a given year, you can meet your income needs while keeping your modified AGI right where you want it. This is what financial professionals call withdrawal sequencing, and it's one of the most powerful levers available to retirees. Strategy number 3. Smooth out your Roth conversions. Roth conversions are an excellent long-term strategy. Moving money from a traditional IRA to a Roth IRA reduces future required minimum distributions, or RMDs, and creates tax-free income down the road. But if you do a large conversion in a single year, that entire amount lands in your modified AGI for that year and potentially triggers or worsens your IRMAA surcharge 2 years later. The solution is to spread your conversions over multiple years, what planners call a Roth conversion ladder. Convert smaller amounts each year, staying within a modified AGI band that keeps you below the next IRMAA threshold. The best time to do this? The window between when you retire and when your RMDs begin is often ideal. Your income is lower, your tax bracket may be lower, and you have more control over your modified AGI than at almost any other point in retirement. Strategy number 4. Coordinate your RMDs with your other income sources. Once you turn 73, required minimum distributions are mandatory. You cannot avoid them, but you can manage their impact. One of the most effective tools available is the Qualified Charitable Distribution, or QCD. If you're 70 and a half or older, you can direct up to $105,000 per year from your IRA directly to a qualified charity. This distribution satisfies your RMD, but it never shows up in your adjusted gross income. It doesn't count toward Modified AGI. It doesn't count toward the Social Security income threshold. It's one of the cleanest tax and IRMAA reduction tools in the entire tax code. If you're charitably inclined, this strategy alone can save you thousands in both income taxes and Medicare surcharges every year. Strategy number 5. Use the right financial tools. Not all retirement income is treated equally. Some sources are Modified AGI neutral, and building those into your retirement income plan gives you flexibility and control. Roth IRAs, as we discussed, produce tax-free income that doesn't affect your Modified AGI. Health savings accounts, when used for qualified medical expenses, are also Modified AGI neutral. Cash value life insurance, when accessed through policy loans, is not considered income and doesn't touch your Modified AGI. And fixed indexed annuities funded with after-tax non-qualified dollars are worth mentioning here. When you take withdrawals from a non-qualified annuity, a portion of each payment represents your original premium, your cost basis, and that portion comes back to you tax-free. It's called the exclusion ratio, and it means part of your annuity income simply doesn't count as income for Modified AGI purposes. That can be a meaningful advantage for retirees who need income but want to manage their Medicare exposure at the same time. The bottom line on strategy: a thoughtful income plan uses multiple sources, each chosen in part because of how it affects your Modified AGI. That's how you create retirement income and protect your Medicare premiums at the same time. Before we wrap up, I want to come back to that 2-year look back, because the timing here is just as important as the strategy. Every financial decision you make this year is going to show up on your tax return, and that return will be used to determine your Medicare premiums 2 years from now. That means planning cannot be reactive. By the time you see the surcharge on your Medicare bill, it's already too late to undo the income that caused it. Now, there is a safety valve. If your income has dropped significantly due to a qualifying life event, retirement, the death of a spouse, divorce, loss of pension income, you can appeal your IRMAA surcharge by filing Form SSA-44 with the Social Security. Medicare may agree to use a more recent year's income instead, but filing an appeal after the fact is always harder than planning ahead of time. The most powerful position you can be in is one where you knew the thresholds, you planned your withdrawals accordingly, and the surcharge never triggered in the first place. Here's what I want you to take away from today's video. Modified AGI management is not just a tax strategy, it's retirement income planning. The two are completely inseparable, and the retirees who understand that and act on it are the ones who protect the most income over the course of their retirement. Small adjustments to your withdrawal strategy today, sequencing your accounts, smoothing your Roth conversions, using QCDs, choosing the right income sources, can easily save you thousands of dollars per year in Medicare premiums, year after year. If this video helped you, please get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. If you found value in this video, please give it a like. It helps more retirees find this information when they need it most. Subscribe so you don't miss the next one, and drop a comment below and tell me, which strategy surprised you the most? I read every comment. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.